Hi, everyone, and welcome to our VIP mortgage webinar that we are hosting today. You have myself, Brianne Gardner, along with my business partner, John McLean, and we have our lovely guest, Drew Donaldson, who is our expert that we have brought in to discuss all things lending, financing, and mortgages, especially with Bank of Canada and rate decisions and the path forward. Drew, founder of Donaldson Capital, brings over 20 years of experience in the lending and financing world, both within the residential and construction sector. He has been named top 15 mortgage brokers in Canada and continues to serve clients through a customized approach to each their situation. So Drew is a trusted partner of ours at Velocity Investment Partners and has helped many of our high net worth clients in their desired situations to solve some of their lending needs and refinancing and purchases of their properties. So we are happy to have him. We will start with this webinar and then go from there and see how things go and ask Drew some questions. So every week, we hear from clients, my mortgage is up for renewal soon, or I'm looking at lending and I'm not sure what to do. I have a line of credit. Should I take advantage of that? Should I look at fixed or variable, 3 years or 5 years? And really, our goal as your financial CFO is to help you make informed decisions that fit your life and your goals and within your means, and looking at how to best execute on that choice for you. So we have seen a massive renewal wave come through. Roughly 60% of Canadian mortgages have renewed this year or will renew in 2026. And that's impacting over 1.2 million households and about $600 billion in mortgage values within Canada. So homeowners who locked in at the pandemic, including myself, around that 1.6 to 2.5 range, could now face renewal rates near 4 to 4.5%. And that's adding about $300 plus, if not more, on a $500,000 mortgage. Obviously, scale that up for some of our clients who have, $1 million properties or investment properties. And now we're starting to look at, what is the best rate for you? So in higher cost areas, especially Greater Vancouver and Greater Toronto, renewals could increase, a few $1,000s, which is what some variable mortgage holders saw when rates first went up in the peak back in 2022. So variable rates are likely going to be the cheapest option over the next 5 years. But again, we'll bring in our expert Drew to talk a little bit more about that. And fixed rates typically mean paying more interest over the same 3 to 5 years, but with the certainty of the payment not changing on you. So we're seeing prime currently sitting around that 4.45% today. And a lot of analysts and economists are forecasting that they expect it to drop slightly in 2026. Really renewing early or exploring options before your lender's offer can save thousands. And many borrowers overlook prepayment privileges and timing strategies that could reduce these interest costs. The Smith maneuver, we'll talk a little bit about that as well, is something that many high net worth families that we work with use to make their mortgage tax deductible. And doing this is at renewal time is certainly ideal. Again, flexibility features we're looking at too, and we'll discuss is the probability, repayment options, and penalty structures that can make a big difference in your overall cost. Often overlooked is in the renewal decision. Drew will speak about this as well. Although we don't have a crystal ball, no one knows exactly when the bottom of interest rate is going to happen, but we hope to provide some insights and really an outlook that can help our clients and anyone listening to this to make an informed decision in the future. So, John, why don't you take it over and we'll talk a little bit about the current market snapshot and where we are today.
Thanks, Brianne. Yes, quick refresher, just on interest rates in general. The Bank of Canada uses them to control inflation and stimulate the economy. And in 2022, we saw interest rates skyrocket, and prime rate went from the rock bottom of 2.45 up to 7.2% in the matter of a year and a half. They did that to try to control inflation, get inflation under control during the just after the pandemic. It's back down to 4.45 today, which is considered neutral by us. It's not so expensive to keep slowing the economy too quickly, but it's not so low as to stimulate spending too much and drive up inflation. And when they're setting interest rates, there's a number of factors involved, but the big three would be inflation, unemployment, and GDP. Those are essentially the big three factors. Inflation is now down to 2.2, just over 2%. It's hovering around that 2% target now, and it's been there for about a year. This means theoretically, prices of things are 4 to 5% more expensive than 2 years ago, 2023, and 2% more expensive than last year. It doesn't mean that things are going to get less expensive. It's just that year over year, it's a smaller change, and that's what the government considers sustainable. Even if certain categories are worse than others, that's their 2% target is the where they want to be, and that's where we are today. Unemployment rate in Canada unexpectedly went down at the last reading, which was a bit of a surprise. It's good for the economy because if people have jobs, they'll keep spending money. And if they're spending money, corporate profits are going to be steady, and there's fewer layoffs. But if unemployment starts to soften, then the Bank of Canada will have to cut rates faster to give people more money to spend, which will then improve corporate profits. Companies will hopefully start hiring again and it's a bit of a cycle, a balancing act for them. And the third part, GDP. That's the gross domestic product of Canada. It essentially measures how much stuff we create in a year, and Canada wants to avoid a recession where our GDP numbers go down year over year. And this is the one reason that the Bank of Canada might take a slower approach to lowering rates. Interest rates are their ammunition against a recession. And while we narrowly avoided a negative quarter so far, it looks like it's still getting weaker. Remember that it's two negative quarters in a row that officially define a recession. And so, it's usually we're 6 months into a recession that we find, surprise, you're actually in one right now. But if the Bank of Canada keeps dropping rates consistently, they should be able to delay a recession. But what they worry about is that if the US economy stumbles, Canada will feel it. And that's when the Bank of Canada will really need to slash rates further, and why they might take a slower approach to doing it. So interest rates are important because it affects the housing market. The combination of the huge glut of condo supply as well is affecting it. But the reason that real estate prices are essentially flat for the last few years is a combination of interest rates and supply. So, Bree, maybe you can give a bit of an outlook on where we see rates going over the next year or so.
Yeah, I'll just briefly touch on kind of our rate expectation and what our outlook is. As John mentioned, prime currently at that 4.45% today. We do see more cuts on the horizon. What that path looks like, I think will be determined a lot by the economic data that we do get and continue to see out of Canada. Right now, we think about another 50 basis points, maybe 75 basis points in cuts over the next 6 to 12 months. That would be under normal conditions if we don't see weakening economic data from Canada, where the economy kind of stays afloat, unemployment stays relatively decent, and really the country sees some, at least mild economic growth. So that would drop prime closer down to that 3.95. If we see weakening economic data or negative GDP, or, this is the ammunition that Bank of Canada does have to help us sidestep or avoid a recession, we could see more aggressive rate cuts. And if we do see that, that would show the economy is slowing, given the trade wars, the tariffs, Ontario manufacturing sector issues, et cetera, that could potentially drop prime down to that 2.95 to 3.45. So this is certainly important when we're thinking about our clients and their lending, their mortgages, the amount of Canadians that are investing in the real estate environment as part of, your total overall wealth picture. We look at everything, not just your investments. And again, really whether to go fixed or variable. So let's bring in our expert, Drew Donaldson and of Donaldson Capital, and have him answer a few questions and give some of his thoughts and feelings on and advice really on. I think the burning question, Drew, that a lot of people are wondering is really to go, should they go with fixed or variable? What are your pros and cons of each? Who benefits the most in today's environment? And maybe, some of the risks or flexibility consideration that investors and clients should be considering.
Yeah, thank you for having me, John and Bree. Really appreciate it. I really think we're speaking the same language. I mean, everything that the two of you just touched on from an interest rate perspective is pretty much in line with exactly what I'm seeing, reading, hearing. We keep a close eye and pulse on the market. So that 7.2% prime rate in July of 2024 sounds bad. And at the time, to be honest, it was. But the kind of the positive to all this is now we're down to that 4.45% level. And like the two of you just expressed, and I feel the same sentiment, we're probably going to see another 50 to 75 bip in prime cuts over the next 6 to 12 months, which means now we're below 4% prime. And we can look into both the variable, which I would say 80% of our clients right now are going variable. It is the burning question, do I go fixed? Do I go variable? What do I do? And, there's been other times where we've said, hey, take a 3-year fix or take a 5-year fix. But at this point in the cycle, the Bank of Canada has been pretty clear that, they're not looking to raise rates. The neutral level is actually lower than where it is today. And the Bank of Canada, yes, they have a strong correlation with the prime rate, but typically the bond market also reacts off of what the Bank of Canada does. And then on top of that, we look at the Fed. I mean, I was listening to the Fed speak today, the Fed and some of the cabinet ministers down in the US. And, they're talking about how inflation is going to roll over next year. Scott Bessent, one of the Treasury guys, was talking about that. So if inflation rolls over in the US and the Fed is able to cut, that is good news for the Bank of Canada because the Canadian dollar is something they really have to keep a close eye on. And if the Fed cuts, that kind of gives room for the Bank of Canada to cut as well. So to answer your question, I know I was taking a little minute there, but 80% of our clients are going variable. The strategy right now for a lot of our high net worth clients is take the variable, ride it over the next 6 to 12 months. We don't think it'll be necessarily a long 5-year process. But over the next 6 to 12 months, we'll look at a ideal time to convert your variable rate mortgage into a fixed. And hopefully we come back to, 2.99 or 3.25, something lower than where it is today. And today you got a fixed rate, roughly 3.99, maybe a touch lower. Variable is about the same, 3.75 to 3.95. So we think that's going to inch lower 50 to 75 basis points more.
And a quick question on that. So when, in your experience, when fixed rates hit their lows versus variable hitting their lows, obviously variable is tied to what the Bank of Canada does, but do you see fixed rates tend to bottom before, or do they do it fairly close to each other where you can actually wait till you get the cheapest possible variable before going over to fixed?
Yeah, they're pretty strong correlation. Right now, we have the variable and fixed roughly the same. We do think variable might lead the way this time. So variable will go lower, and then what you'll see is you want yourself to have a little bit of time before you convert your mortgage. So if variable gets down to like 3.5%, and then all of a sudden a 2.99 5-year fixed rate comes out, well, that'll be a very optimal time to convert your mortgage. The thing is, when rates go down, there could be a chance that if the tariffs get sorted out, which eventually we think they will, rates go lower and growth really starts to spur, there could be an opportunity where rates go low and then they pop back up a little bit. We don't think 7.2% is realistic anymore. We're not really fearful of that at this stage, but we do think you could see a kind of a low point in the rates again, and then maybe a blip up on the chart where rates go higher. So there will be an opportune time to convert lower than where they are today. And, some people, some retirees or first-time home buyers, they want to go fixed, and that's perfectly fine. But we do think kind of the wise play here is to ride the variable for a little bit of time.
Yeah, and you know what, Drew, we certainly agree. I think sometimes the security of the payments and locking that in and feeling that safety, we do have, some clients or retirees that maybe feel a little bit more comfortable with that. But we're certainly advising our clients right now, if you are up for renewal or looking for renewal, we do expect more rate cuts. So we would go with a variable, at least on the short term, and then look at locking in as well. We do have a lot of questions from clients as well on should they break their mortgage early to refinance, and then maybe just on that refinancing option, can you speak a little bit to, some of our clients are getting notified almost 3 months in advance of their renewal date. So maybe some strategy over, what the lending institutions are doing and what you might advise for a client who does have that up for or refinancing to look into.
Yeah, yeah. So, I mean, I had one this morning, a 1.59% 5-year fixed rate at TD, renewing in April of 2026, right? So they came perfect time, past client. I actually placed the mortgage with TD at the time. Came to me and said, "Hey, TD is already reaching out. What do you think I should do?" And I said, "Great, this is perfect. Let's start the process early. We can go get it approved." So we had to go through the conversation of, do we renew at the current balance and the current amortization, or do we want to take cash out, either to invest or for renovations, buy a rental property, many, things that pop up. And we decide there whether it's going to be a straight renewal or it's going to be a refinance. And then at that point, we can set the loan size and the amortization. So it's always good when the renewal is coming up to get ahead of it. So what we do is we get the optimal structure in place in the beginning. We set the loan size, amortization, we get it approved. And then I always tell clients, I'm like, listen, you're not renewing till April. Let's just sit tight. Let's sit tight and see what we did, what happens here. Because I can go get you approved at a fixed, or I can go get you approved at a variable. Now you know that those are kind of the worst terms you're going to have between now and April. But now let's watch, hear, listen, see what happens to interest rates. And, let's not make a decision until maybe March 1st. And at March 1st, we say, okay, now is the exact loan size I want. Here's the term I want. Maybe at that point in time, all three of us are thinking we have a different pulse on rates. And maybe the fixed rates drop to 3.25, and we're saying, hey, it might not go much lower from here. Maybe it's a good time to lock in. So I always say, get ahead of it. Let's talk about structure, how we're going to set it up, but we don't need to rush to just sign the paperwork and finish the deal. I think a lot of times it's the pre-planning and discussions which open the door to making sure that the right strategy is in place.
When it comes to the 3-year versus 5-year terms and the rates, I noticed like 5-year used to be the most popular, and now it seems to be 3 years. Maybe you can touch on what you're seeing and whether you expect that to go back to a 5-year, whether that's going to be more competitive in the near future.
Yeah, there has been times where, we've said take the 3-year over the 5-year. If we thought, rates were going to trickle lower for 3 years, maybe come up for renewal a little earlier than that, than the 5-year. Right now, I would say we're typically saying it's either 5-year fixed or 5-year variable. It's like, the variable you can convert at any time without penalty. So it's like, hey, if you want to lock it in, let's kind of forget about this till 2031 at this stage. Um, or if you want to take variable, then let's at least enjoy the benefits of variable and convert when we need to. There is the odd time where someone will say, hey, we're definitely going to sell the home in 3 years, then great, 3-year fix makes sense. Or they're going to be switching jobs, or if there's a life event that lines up in 2028 or 2029, maybe even a liquidity event. Some people are selling their business or have an exit from a private equity deal, and they know they're going to be able to pay off the mortgage or do different things. At that point in time, we'll line up the term based on what they're looking for. But most of the time right now, it's 5-year fixed or 5-year variable.
Yeah, and I think a lot of people maybe aren't as sure too, what happens when things are coming up for renewal. You said start the process early and you had that discussion with TD. I think, do clients have room for negotiation? Can you maybe talk a little bit about that? Should they be looking at switching lenders? The benefits about exploring their options, and maybe, again, I know you said looking in advance, but not actually securing. But, some people can be a little bit nervous when the renewal process starts because it can be overwhelming with these are your options. Is it a take it or leave it?
Yeah, good question. We work with 50 different lenders. We're not tied to any one lender. So we're not really biased on that. We always say, if TD, for example, wants to send their renewal package, amazing, let us know what it is, send it over to us, and we can either place the deal back with that current lender, or we can look at all the other lenders we have out there, MCAP and Manulife and BMO and Scotia, and you name it. So I wouldn't say that. I wouldn't say that just to be tied to one. I also think your question earlier about refinancing, if there's not a life event, now usually there is a life event. There's things from divorce to, buying different investment properties to cash out, liquidity. I actually had a lady this morning. She's buying into a business, right? It was almost like she's not a lawyer, but it was similar to like a law firm type of buy-in to a large business. And she needed a loan for that. So we were talking about how you add a home equity line of credit and can go through that. But if none of those things are present, which again, 8 times out of 10, there usually is something, we then just look at the numbers and we say, hey, you're in a 5.99 5-year fixed rate. You've been in this mortgage for 2 years. We can do either a variable at 3.95 or maybe a fixed at 3.99. Let's see how much you would save between what you're paying, bundle in the penalty, and then your maturity date. And we can typically line it up fairly close, the maturity date. And that's where John's talk about 3-year fix would come into play, right? If there's some clients that say, you know what, I'll roll the dice and take a variable, and I think I'm going to make this amount of money on the savings. But there's others that say, I want a concrete savings plan here. So if I have 3 years left on my term, can you line up a 3-year fix so we know exactly how much we're saving? And we look at all the options, we break it down, and I'll tell you, it's one of my favorite things to do is sit there and save people money on their mortgage because, it's a little shuffle of paperwork. You send it to the lawyer's office. Next thing you know, a client saves $10,000 or $15,000. Sometimes we've saved upwards of, $80,000 to $100,000. You'd be amazed at some of the savings. And that's always a fun thing to watch when people get excited, and they don't really have to do anything. They don't even have to leave their home most of the times.
And Drew, sorry, just a quick follow-up on that. This is a simple question, or simple, but I feel like it gets asked all the time. And you dealing with so many different lenders, why are different lenders quoting different rates?
Yeah, most of them are publicly traded, not all of them. But they have, what I find is all of a sudden, maybe it's, Scotia or, I'll try not to name too many lenders, but they'll all of a sudden get dumped a bunch of money, like billions of dollars, where they're like, we got to get this out the door in the next 90 days, right? And so their margins might go down, and they're like, hey, we need to just push this out and make sure we're bringing in clients, because we've got all this money sitting on our balance sheet. And then there's other times where we just find seasonality where, certain lenders seem to be in May through June or July buying up as much business as they can because it's the spring market, trying to buy up that business so that toward the end of the year they can kind of take the foot off the gas and maybe not be as competitive. So we see different lenders have a different seasonal approach to it, which is kind of funny to watch over my 20 years where I'm like, oh, here we go. I know this lender is going to come out with a special pretty soon. But in the end, it really doesn't matter the lender. The client can provide whatever void check they want from whatever institution. Really, at the end of the day, is getting the right structure, the right product in place, and good pricing too.
And on that note, speaking of different lenders, one thing we've noticed is some of them, when you're coming close to the renewal date, some of them allow you to basically pay it off within 30 days or a couple of weeks, and some of them are like, no, you have to wait till the very last day before paying it off. Which is more common, do you find?
Yeah, if you're within 30 days, you can typically pay it off, but you would have to pay it off with whatever loss of interest there is till the end of the term. Now, that's if you're paying it off or taking it to another lender. But yeah, I mean, most would prefer it actually take place on the day. They order a payout statement. Typically, the law firm does that, and they want you to pay it out on the exact day. And a lot of times it's because maybe they bought a 5-year bond at the time that you took the 5-year fixed rate, things like that. But they're offsetting on the back end on however they book the profit on the deal. They typically want it to align with the maturity date. And if the maturity date is not exact, they want at least the loss of interest, if not 3 months interest penalty on the mortgage.
So then because we've had both cases where someone was able to, in the event of, for instance, doing the Smith maneuver, which is where we'll use non-registered money to pay off the mortgage at the term maturity, and then they just borrow again, refill their investment account, and it makes their mortgage tax deductible. But one institution allowed us to do that, a couple weeks before the actual term was up, and one of them we had to wait until the actual day before to be able to do that transaction.
Yeah, I love the Smith maneuver too. It's just such a great way to make your mortgage tax deductible. But
And maybe
yeah,
we can
it
talk a little
really
bit
depends.
about, who that might be favorable for, like what types of clients we would see. A lot of our top clients, we have been looking at that, especially with interest rates going down. But Drew, maybe you can talk a little bit about, who would be the ideal client to take advantage of the Smith maneuver.
Yeah, I think if someone has a free and clear property today, but they still have solid income, earnings, maybe a business, they're going to look at it and say, do I really want to be mortgage free and save myself 3.99%? Or can the two of you earn them, 7% or beyond that, right? And you just look at the arbitrage opportunity. And on top of that, when the interest becomes tax deductible, you bring that to your accountant, and he looks at it and he says, wow, this is pretty good. And it's not that every year they're going to make a 7% return or a 10% return, but over time, the stats show that the market's going to continue to go up. In those instances, we do sometimes go fixed rate opposed to variable just to lock in the return where, the client says, I don't care if it's 3.99 or 2.99. What I care about is over the next 5 years, as I invest my money, I know exactly the monthly payment that I'm paying. I actually had a client this morning who said, I will go variable, but I want a home equity line of credit because the money they were investing, it was very easy for the accountant to track it. It actually lowered his monthly payment. So he was taking $1 million. And if you did it amortized on 30 years, it was going to be, I believe, $4,700 a month. And when we looked at the HELOC rate, even at 4.45% today, it was around $3,700 a month. So he's sitting there going, well, I'm only using this money to invest it. Now I'm saving $1,000 toward principal, which I really don't want to pay down the principal anyway. And then I provide my HELOC statement directly to my financial planners. I did tell him that you two were the best in the industry, and he should be switching immediately. So we'll see if we can get him over to you. But these are the little things that you go through with, and you see people where at that point in time you're using your mortgage as a tool. You're not you. A lot of people, they think maybe when you're a first-time home buyer, you're just trying to get a 80% mortgage on a condo or a house. But as you get into your mid 40s through, I would say mid 60s, maybe even early 70s, if you're taking a mortgage, you're using it as a tool to make yourself more money, looking at the holistic plan, which the two of you do such a great job with. And I guess that's why I'm glad I'm on this podcast with you or video.
Yeah, and you know what? We couldn't agree more, Drew. And that's such great advice to investors, right? If you just look at the basic math and using your mortgage as a tool, a lot of Canadians are raised to be debt free, to, be scared of debt, but there's always that good debt and bad debt. Bad debt, obviously, credit card, high interest rates, but good debt, if you can utilize, HELOCs or home equity line of credits and mortgages as a lending option. And let's say, as Drew mentioned, 4% you can borrow and you're in the highest tax bracket, you get to write off half that. So now you're looking at, you just have to earn 2% in your investment to make it worthwhile. And if we can make you 7%, then you can use your profits from your portfolio to pay down your mortgage and you're still ahead. So, yes, it depends on where we are in market conditions. It all depends on where interest rates are going. This is a great tool right now with interest rates continuously, and our thoughts are on that path downward to take advantage of that. And that is really where you build this multi-generational wealth as well, is to take advantage of these different types of economic swings that we can see. So, John, did you want to ask Drew maybe one more question as we wrap up this webinar?
Yeah, the one of the questions we had was just about adjustable rate versus fixed payment on the variable side. So someone decides they want variable, but the benefits of both, and especially in a falling interest rate environment, which one's more common? Can you get both at any institution, and or is one more favorable than the other?
Yeah, that's a great question and something that we actually went through a lot over the last, let's say, since 2022. So different banks and lenders do it differently. Some on the adjustable side, they'll keep the payment the same, but if your variable rate goes up, obviously your interest on the mortgage is going to go up. Where others are going to say, okay, if the interest rate goes up, your payment's going to also go up. So we had different clients in 2022 that took two different products. Some would see their monthly payment going up as prime was rising. And, alternatively, what we've seen since last year, their payment keeps going down. Others, their payment never moved. And they actually got to a point where they're like, you know what? We're at a 95-year amortization. And the lender was calling them saying, we recommend that you increase your mortgage or make a lump sum toward the balance because your amortization is not 30 or 25 years anymore. It's now jumped up to 95 because you're paying, let's say, 3,000 a month, where because rates have gone up so much, it's actually 7,000 a month of what it should be. I would say in this environment, with rates going down, a lot of people are saying, I would prefer to be on the one that adjusts the payment lower so they get to take advantage, especially our high net worth clients who are saying, you know what, cash flow to me, a mortgage payment is a mortgage payment, but if I have extra cash flow, now I can invest it with my financial advisor. That's really how they think. And then there's other people who just want certainty, and it goes to, I'm going to take a variable product, but I want to know exactly what that monthly payment is every single time. Those would be the people that, you do more on the adjustable side.
Yeah, and I think we were happy to have Drew's expertise to come in and really dive deep into the mortgage world. And one of the benefits about, collaborating and working with Drew and Donaldson Capital is that, and a mortgage broker, is that he shops the entire market, right? Unlike a bank, which can really only offer its own rates, as Drew mentioned, dealing with multiple lenders, and he compares. So he still has access to all the banks, credit unions, alternative lenders, private lenders, whatever the unique client situation needs. They are there to help negotiating on client's behalf and really structuring the deal strategically in the client's best interest. So managing the entire approval process from start to finish. So we have seen some tricky situations or complex situations that they have stepped in to certainly help make sure that that has been a smooth transition, and always providing unbiased advice, which is really important to all, especially John and I, on how we service our families that we work with. So again, Drew, one fireside quick chat question we have is from clients. Is the housing market, or if you're a buyer or seller next year, where do you think real estate prices are headed through 2026?
Yeah, there's a lot to go into that question. The condo market, it's obviously in a bear market right now. I think that is going to take, a couple of years to kind of sort itself out. But when I think about that question, I think about, just the conversations I have with people on the phone every single day. And I always tell them the same thing. I say, there's the macro noise, which it's really the three of us are responsible to pay attention to the macro, whether it's interest rates, whether it's the housing market, what's going on a national level, regional level. But really, all that matters to the individual client is the micro level. What is the house that you buy and the house that you sell? If the house was listed for 2 million and then it dropped to 1.7 and you can somehow get it for 1.5, you know, that looks like a win to me, right? That on a micro level, that looks like a win. And if you're happy moving into that house and staying in that home for 10 years, again, that makes a lot of sense. That's a win. But the rest of it is it really is noise. What's happening, whether it's Vancouver or Toronto, it's really neighborhood specific. It's individual. People ask me about, should I go fixed or variable? And, before I even know where they're buying, their down payment level, what their stock portfolio looks like, or their income. So it really is a personal decision. On top of the three of us here, it's really important to get a good realtor who knows what they're doing and knows the market. The two of you can talk about their investment portfolios and the holistic approach all day. I can talk about the mortgages because I live and breathe it every day. You also need a good partner on the ground that is looking at the real estate and helping you. I can give an opinion on the phone of what I think or how I would negotiate the deal, but that trusted partner on the ground is going to help the client. So do I think now is a good time to buy? I do. Very, very specific to each situation and each location and how long you're going to be in the property. Those are things to consider.
Well, thank you, Drew. We really appreciate you taking the time to join us. We know that there's a lot of nuances when it comes to mortgages, and there's a lot of options and that they need to be discussed. That's why we send them to experts like you to be able. You can ask the right questions to make sure they have the right mortgage for them. I think our clients will have gotten a lot of value out of the insight on this. And while, like Brianne said, there's no crystal ball as to what the future will hold. Some educated and informed outlooks can help them make that decision. So thanks again for joining us.
Thank you both.
Yeah, thank you everyone for tuning in. And if you do have a mortgage up for renewal or have any questions about your current rates, or are being contacted about your renewal process and wondering about fixed or variable, or look at purchasing a property, please feel free to reach out to John or myself, and we're more than happy to pass along Drew's contact information from Donaldson Capital and connect you directly. Again, thank you for tuning in to our VIP webinar, and looking forward to chatting with you soon.